Thought leadership from PwC's National Office.
Hello, I'm Heather Horn, the host of Sustainability Now, and thanks so much for joining us today. One note before we jump into today's episode. We recorded this prior to February 26, 2025, when the European Commission released its first omnibus package of proposals to, quote, provide substantial simplification in the field of sustainability and EU investment programs, end quote. For more on these proposals, please look for an upcoming episode, and we've also linked a number of resources in the show notes. In the meantime, these proposals are draft and subject to change through the adoption process. So in today's episode, we'll continue to focus on the currently enacted requirements. With that, let's jump into the recording. Hello, and welcome to PwC's Accounting Podcast Series. I'm Heather Horn, PwC US Sustainability Technical Leader, and I'm so happy you're joining us today. Today's episode is planned as the final episode. Who knows, we may do a few more bonus episodes in our video podcast series on sustainability reporting. And as I said, this in a way is a bonus episode because we're actually going to hit some frequently asked questions about GHG emissions reporting. So those of you who are regular listeners will know that last fall we did an entire series on GHG emissions reporting. So if you need the basics, I highly encourage you to go back to that. And then even last week, we did a compendium of information giving you a lot of the highlights in reporting. However, we have been getting so many questions as companies get into practical implementation, particularly for companies that are first-time adopters of ESRS, the European Sustainability Reporting Standards, for companies reporting in the EU under the Corporate Sustainability Reporting Directive. So my guest, Marcin Olowinski, and I thought that we would bring you some frequently asked questions in GHG emissions. And not that Marcin needs a big introduction, but just in case, as a reminder, Marcin is a specialist in our national office focused on GHG reporting and the chair of our GHG Global Working Group and serving clients in the sustainability working space and one of the lead authors of SRG 7 Sustainability Guide, a reporting guide on GHG, and probably more. Do you want to add any more accomplishments, Marcin, or is that enough?
I'm also serving multiple clients.
There you go. Thank you. Although I think I said that, so you weren't listening to me. All right. So with that, now we'll get into good stuff. So as I said, Marcin, we obviously have covered a lot of the basics. So for listeners that have not listened to some of the basics or don't know the basics, this episode may seem to jump around a lot because we are going to jump into different topics, but I think they're great ones because they're all the ones that we've been getting questions on. So I'm going to start with the starting point, organizational boundaries. And I know, ESRS has unique rules for organizational boundaries for people that are used to preparing their organizational boundaries under the GHG Protocol. And we continue to get a lot of questions there. So what are some of the areas we're getting questions on?
I think it's, you're absolutely correct. And I think we're receiving questions because of the nature of ESRS guidance in this area. So as a reminder, and I know we might have a mixed audience, so the uniqueness of ESRS organizational boundary guidance is two-step approach. So the first, companies have to consider reporting emissions from subsidiaries fully consolidated in financial statements. And then for all the unconsolidated subsidiaries, joint ventures, and other type of arrangements, you have to consider operational control. And if you have operational control, you have to report also 100% of Scope 1, 2, and relevant Scope 3 emissions. Why it is kind of creating problems? Because a lot of our clients have experience reporting emissions. Usually they're doing this using one or the other. So,
well, that's what's permitted under
exactly,
the GHG Protocol.
Yes, exactly. So, which means they might not be fully familiar with the concept of the other approach that they don't. So, therefore, we start having the questions about how you approach those, what is the practical difference between the two, and we start having more specific kind of application questions in various areas. And today I'm going to just, as an example, to illustrate, focus on two of them, leases and investment company accounting for emissions from the investees. Again, this is not overarching issues, but as an example of what type of questions we're getting. and what does it mean for practical application, right?
Yeah, and I think a key point there, Marcin, and this is something Diana and I talked about earlier in the series when we're talking about reporting boundaries more broadly, is that the reporting boundaries or organizational boundaries for GHG apply to entities, assets, and operations.
Mhm.
And again, this may apply in the financial statements, but we don't think of it the same way. And that's where I think leased assets
Mhm.
comes in. It's in the assets category
Mhm.
of these entities, assets, and operations. So, with that said, again, as a reminder to listeners, ESRS, that we are talking about ESRS here.
Mhm.
So, this will not apply if you are talking about GHG protocol or reporting under ISSB.
Mhm.
But what are the issues under
Mhm.
ESRS?
Quite frankly, the issues with lease accounting under ESRS are connected to the problems of GHG protocol. So, as a reminder, I'm gonna do it as a starter. So, GHG protocol has a specific model to account for leases, which depends on the type of a lease and organizational boundaries selected, right? So that's a starting point. In general, the operational control is assumed to be held by lessee, who's considered to be operator of leased assets. The problem begins with the fact that GHG protocol did not update its guidance to reflect the changes in accounting or financial reporting of leases. So the guidance is based on old lease accounting pronouncements under IFRS on the US GAAP. And as we all know, the IFRS and US GAAP changed accounting for leases quite substantively. In particular, under new guidance, all lessees have to record right of use assets that relates to the lease arrangements they have. So now, historically, only certain type of leases resulted with booking out recording of the assets. Now, all lease types result in recording of right of use assets by lessee on a balance sheet, which is quite significant change, right? So we're getting questions from clients. Okay, what does it mean for my reporting under ESRSs? And it's kind of a complicated issue, and it diverges from historical practice because when you think about it, the two-step approach, first part of the approach is reporting emissions from assets that are fully consolidated in financial statements of reporting entity. So the question is, okay, now I have a right of use assets, which we already published the position, lessee should report emissions from scope 1, 2, and a respective part of scope 3 from right of use assets, which creates certain issue.
Well, yeah, I just want to pause this there, though, because I think for us, you can go pretty fast through this because we've been through it so many times. We talked about this for months and months, but let's pause a bit on lessees. So again, what you said under the GHG protocol, the historical model, the unupdated model, is that you would base everything on operational control. And then there's some differences. And even under the GHG protocol, we think that you may need to make some changes to how you're reporting emissions under the new guidance. But now, under ESRS, those assets, you have the right of use asset on your balance sheet. And so it is in your financial control for and operational control across the board for lessees. Is that what we're saying?
Yeah, so like it's under two steps. Even if you conclude somehow that you don't have to do it for right of use asset, then you have to assess operational control. As I said before, lessee is presumed to have operational control of all these assets, right? So whichever way or direction you take, you're always going to end up, lessee has to be reporting scope 1, 2, and 3 emissions associated with leased assets, right?
Okay, so that's easy. I'm the lessee, I report. All right, so now lessor.
Well, so that creates certain problem for lessors, right? Because lessors, depending on a type of lease, you can have two scenarios. Either you retain the physical asset on your balance sheet, like as nothing happened, let's say, so it's part of your fixed assets, or you can have situations whereby in certain types of leases you can remove or de-recognize this physical asset and recognize like lease receivable, right, on your balance sheet. So now, depending on which scenario you are, if you continue to report physical assets under ESRSs, based on our interpretation, you have to be reporting scope 1 and 2 emissions because this asset is fully consolidated on your balance sheet, right?
Yes.
When you don't have that asset, but you have a lease receivable, we think it's akin to like a loan or finance emission, and a lessor could be reporting scope 3 category 15, or actually no, that's
Category 11.
category 11. Well, not 11.
Yes. 13.
13.
Yes.
Category 13.
Okay, third time's the
downstream,
charm.
yeah, downstream leases, right? So,
Yes.
but the first part is that's where it's a little bit problematic under ESRS, because what you're gonna end up having is two parties might be reporting the same emissions, because you have two types of you have assets related to leases recorded on your consolidated financial statements, which is a little bit contradictory to historical practice under the GHG Protocol, which presume only one party is gonna report those emissions. So that's why clients are a little bit uneasy. Well, I'm gonna have a double counting in there. We think it's fully supportable. First of all, because of a change of accounting model for leases. Second of all, in our opinion, the ESRS two-step approach presumes that situations, not only for leases, also for unconsolidated investments, it was designed to potentially requiring two separate parties report the same emission.
So, Martin, one thing I want to pick up on what you just described, because as you were walking through the model, you mentioned fully supportable. And I think sometimes that gives a context of it's something people want to do. And is it okay in the guidance? And I mean, I think in this case, when we read the guidance in ESRS, this is what it says that lessors should do, because they have the asset on the books. In the scenario where it's not a financed receivable, they should be reporting scope 1 and scope 2 emissions. However, I know that this has been an ongoing discussion because there is some concern from lessors. Is this really the model that was intended? And so can you just give sort of an update on where we are in terms of what's required and what we expect to see over the next year?
Yes, you're absolutely correct, Heather. So EFRAC received multiple questions on these topics, especially from lessor side. And we know they were considering the topic, just, is there any explanation needed or update to the guidance? We hope that they're going to issue that FAQ last year, but because of the complexity, they decided to postpone it to 2025. And so we urge everybody to look for this guidance in 2025 until it's issued, because there is some judgment. Other approaches may be acceptable, some industry practice and things like this. But we definitely urge clients to look for this guidance and see which direction the EFRAC is going to take.
All right, I agree. And maybe the other thing I would add for listeners is I think Martin and I teased you a little bit with the guidance for GHG Protocol and people reporting under ISSB. So definitely, if you want to know more on that, check out our discussion in SRG 7. And in addition, I think if you want to understand better some of these implications for lessors under ESRS, there's also both for lessees and lessors, there's some discussion in the SRG, just in case you want to know more. So, all right. So definitely a lot of judgment there, and one that I think will be important for companies to discuss among themselves and with those charged with governance to the extent applicable. But let's move on, because I know another area where we've been getting a lot of questions, again, under ESRS, is how you report emissions associated with investment entities. So what challenges are we seeing there?
Yes, again, very good question, Heather. The unique nature of the challenges there is a very specific accounting model for investments that is available to investment entities. So upon meeting certain conditions, IFRS 10 and ISC 46 allows investment entities to a certain exception to the general consolidation rules. So irrespective of size of investment or size of a percentage of their holding in investee, they don't have to consolidate their investments. They can report them as a one line item and measure this on a fair value, right? So again, irrespective of size of their interests. Which, yes.
No, I just, before you go on, because I think you're going to start to get into that counting. And for our listeners that are very familiar with these models, you're probably thinking ASC 46. That's not exactly right, but it's ASC 946. Yes. Right. So I just want to make sure for those listeners, that we got that right. So anyway, I'm sorry. Yeah. All right. So go on.
Yes, obviously 946. So based on this accounting model, investment entities get exception from general consolidation rules, and they don't have to consolidate those investees. report them as a one-line item, and measure on based on fair value. So that again, even if an investment entity holds controlling interest. So question arises, how do we consider this in a two-step ESRS model? The first one is theoretically fully consolidated group, then operational control, fully consolidated people, it's equating to financial control. So how we do this in this
because there's like in between, right?
Exactly. Yeah. So our interpretation of this issue that because of ESRS E1 paragraphs 46 and 50 specifically say that unconsolidated subsidiaries are not part of consolidated group, right? And companies have to assess operational control. Therefore, we think that under the first step of the assessment, it does not have to be included. So companies still have to, investment entities still have to assess whether they hold operational control over those investments. Obviously, depending on facts and circumstances, that might differ. As a general principle, and we have it published in our SRG Chapter 7, we make the we conclude that operational control is oftentimes equated to what we call boots on the ground approach. So party that actually actively operates an asset or entity has operational control. It's more complex assessment.
Much more complex.
Yeah, you have to consider, especially in this situation, right? You have to consider existing contractual arrangements, especially where arrangements where financial interests might differ from some operational type of arrangement. So generally, companies will have to assess those arrangements. But typical practice for investment entities, they're more interested in more strategic control over investments, not operational. They oftentimes don't get involved in operational matters of a company. So we would expect that oftentimes they would also conclude they don't have operational control. Again, I just want to make sure I don't make any broad statements here. Arrangements have to be assessed because in places like private equity, that might be different because in various private equity type of arrangements, actually PEs are actively managing the company, so it has to be assessed. So, but you can see how kind of a challenging it is for those entities, especially historically. A lot of these arrangements were reported and voluntarily reported as a Scope 3 Category 15. So.
Yeah. So Marcin, so just to reiterate then, so in step 1, they're out. We believe it's supportable to say they're out because they're unconsolidated. They're not in the consolidated group. And then in step 2, you need to make this assessment of whether or not you have operational control. If you conclude you do not have operational control, then you would continue to report under Scope 3 Category 15. If you conclude you do have operational control, then you would report your proportion. Well, it's
100%.
Yeah, of the
investee Scope 1, 2, and 3 emissions.
Exactly. Yeah. So just to be clear, though, if you don't have operational control, you still do need to continue to report Scope 3 Category 15. I think the question can come in is on Scope 1 and 2.
Yeah.
Okay. Perfect. All right. So definitely another area of judgment. I think this is a really good answer, though, for a lot of investment entities, notwithstanding the fact I think it would have been nice to not have to do this operational control assessment. But as you pointed out, this is a very important part of the evaluation. Okay. So let's move on. And again, I promised at the beginning, we're jumping around a little. So we're going to jump all the way to Scope 3 measurement. And one of the things we've talked about in past episodes is the fact that within Scope 3, you then have 15 categories. And, we also have 7 gases. So it's multiplying very quickly, all the different things we need to measure. And one of the questions that comes up is how do you measure in each of those categories? And that's where we have this concept of a minimum boundary. So I know we were talking about organizational boundaries before. Now we're talking about minimum boundaries. So can you explain what we mean when we say that?
Yeah. Again, great question. And just one extra kind of a side comment. Scope 3 generally is an area where we start getting a lot of questions, right? Because of a complexity, because of the guidance, complexity of the nature of calculation methodology. So, and the minimum boundary is one of the first questions start getting. So let me maybe back up a little bit. So as you mentioned, GHG Scope 3 standard requires reporting of Scope 3 emissions disaggregated by 15 distinct categories. So These categories were implemented to reflect the nature of underlying activities, emission-generating activities, and just help clients properly categorize that and measure and report those emissions. As you mentioned, protocol also implements the concept of minimum boundary, right? Minimum boundary it's very important concept because when you think about it, scope 3 emissions or emissions in a value chain, upstream and downstream. When you start thinking about value chain of our clients or reporting entity, it could be vast, could be very complex and almost ad infinitum, right? So the first kind of when protocol introduced the concept of minimum boundary, first they wanted reporting entities to focus on activities and value chain partners that actually matter and contribute the most to each scope 3 category. And then they wanted to ensure that the companies are not going exactly ad infinitum, chasing down the emissions of remote value partners or activities, down the value chain. So that was the main goal, just to put some boundaries around it, make it manageable for a client, but also ensure consistency. So they prescribe what has to be measured and how, and that is one of the ways to ensure consistency, how everybody's is capturing this data, so this data could be compared. It is comparable across different companies reporting those emissions.
Okay, so Martin, I think that's really helpful. Can you just give some examples then of what we see when we have these minimum boundaries? And also then what does the company do if they want to report more information?
Yes, so as I mentioned, the minimum boundary is established for every single category and they might be different. And I kind of consider them in group. There are some categories that have like category from 1 to 3 that require companies to report all upstream emissions it's called cradle to gate basis. So you have to capture all upstream emissions associated with production, transportation and extraction of capital goods, other purchased goods that you have. So it's kind of all upstream cradle to gate. Then in other categories, like categories of requiring category 4, which is transportation, upstream transportation, require only reporting scope 1 and 2 of value chain partners. So it's a significant difference what that boundary represents. The same category 15, right? You require to report scope 1 and 2 emissions or your share of scope 1 and 2 emissions of your investment, and scope 3 if they're significant to the overall kind of emission profile of that investment. So you can see there's a vast differences. You mentioned what else they can report. So protocol also established what's called optional categories. So minimum boundary is something that companies have to report absolutely. If category is determined to be material, you have to capture emissions within that minimum boundary. But their protocol lists some optional categories that companies can choose to report. Let's say, for example, category 4, you have to report scope 1 emissions associated of your value chain partner, which is like emissions incurred during transporting of your goods, so combustion, if this is a combustion vehicle. But optionally, you can report also emissions associated with production of the vehicles that you use to transport. So again, each category has its own minimum boundary and optional reporting categories. Use optional activities, right?
Yes.
They have to include. I think it's very important to fully understand that because it makes huge difference how we look at every category. Right?
Yes, and I mean, there's a huge amount of information you mentioned the scope 3 standard. If you go into the scope 3 standard, they have tables of these activities and then they have descriptions and otherwise. So a lot of information there. And I know I said this was all about ESRS, but let's stick with the GHG protocol for another moment because this then is the foundation for what we're going to talk about for minimum boundaries for ESRS. Martin, you very notably mentioned categories 1 through 3, which are the cradle to gate. And then you also mentioned, I think you used 4 to 14. Maybe you just said some other categories.
I just gave example 4.
Okay,
right?
You just gave example of 4. However, we talked about category 15 investments we've mentioned a few times in this episode, and there are some unique considerations for category 15. And this is a category that applies to almost many companies, not just financial institutions, even though, I think often it's thought of in that context. So what can you share specifically about Scope 3 Category 15 investments?
So as I mentioned, it's interesting category because it actually has what I call two levels of minimum boundary, right? So as I mentioned, that companies have to report their share of Scope 1 and 2 emissions of investments and Scope 3 if significant material. But there is another level of what I call a boundary. Scope 3 standards specifically prescribe what type of investments have to be included in the reporting boundary. And it limits this type of investments or asset classes, you can name it one way or the other, only to 3 types. So it's equity investments, debt investments with known use of proceeds, and project finance. So those are only 3 classes or categories of investments that you have to collect and report emission information.
All right, very helpful. And so, Marcin, I know that we often get questions then about PCAF. And PCAF, for our listeners, that probably those who need to know what it is do know what it is, but this is a partnership for carbon accounting financials. And this was put together by financial institutions to measure many asset categories, not just the 3 you talked about in the minimum boundary. And so I have this guidance out there, this PCAF guidance that is built on GHG Protocol, which means that the GHG Protocol has looked at it and said it's consistent with its standards. So then am I also supposed to follow this other guidance?
So first of all, thank you very much for fully explaining the PCAF. I always make mistake when I try to fully name the. I'm used to just saying PCAF.
Yes.
So maybe let me step back. So as I mentioned, like Scope 3 standard only requires 3 categories, which when you think about it, probably those are most common categories across various type of industries, with exception of financial industry, right? Because when you look at the financial industry, whether we're talking about banks, private equity firms, hedge funds, even insurance companies, right? Their portfolio of investments, it's usually much broader, more complex. They have different asset classes that are not captured by those 3 type of investments. So that's why industry led that initiative and created their own standards to report emissions for reporting of GHG emissions for financial industry, in which they try to capture the asset classes that are most common among the various financial institutions. So as you can imagine, there's more asset classes than the 3. There's actually 7. It includes some additional classes like mortgages or motor vehicle loans and others that are prevalent in financial industries. And that standard provides the measurement and reporting guidance for those extra classes. As you mentioned, GHG Protocol reviewed that and approved that, which means if you report in compliance with PCAF, it means you're also compliant with Scope 3 standards. But application of PCAF is not required to be compliant with Scope 3 standards. What does it mean? PCAF did not change the scope of reporting of Scope 3 standards, in our opinion. Therefore, the minimum boundaries outlined in Scope 3 standards are the only kind of a requirement to reporting requirements to be compliant with Scope 3 standards. So again, key point is PCAF does not change the scope of and minimum boundaries of Scope 3 standards, in our opinion.
Completely agree. And I think that one thing that's very interesting is, again, if you dig into PCAF a bit, is that it was actually designed so companies could also adopt PCAF standard. And so then you would say that you're reporting in accordance with the GHG Protocol and the PCAF standard. And so to your point, it was never intended to be sort of part of the GHG Protocol. And the reason that I think it's important to spend so much time on this, well, 2 reasons. One is obviously so people who are reporting under the GHG Protocol know the answers to this, but also this is going to become very important when we start to talk about ESRS. All right, so let's move to ESRS. And let's talk about the guidance in ESRS and how you would think about this concept of minimum boundaries when you're reporting in accordance with ESRS.
So ESRS, obviously reporting of Scope 1, 2, and 3 emissions is outlined, or reporting requirements are outlined ESRS E1-6. and respective application requirement pieces, parts of E1. It's a very interesting question because ESRS E1 basically does not provide too much kind of a details as to how to report or measure, especially Scope 3 emissions. What it does, it requires reporting entities to consider Scope 3 standard and PCAF for financial institutions, right? It also says that companies should report emissions based on 15 categories outlined in GHG Protocol's Scope 3 standard, and those categories should be consistent